The community has voted and the winner was SoFi Seeking Alpha says sell. And therefore today we will have a look at the Seeking Alpha's bloggers' bearish opinions for SoFi by reading and analyzing the article through it. Let's see if the rating is justified or not and why you should not always listen to the media. And I can tell you, despite the length of the video, it will be a fun one. Hence, grab a coffee or a beer, depend the time you're watching it, and enjoy. And besides, before starting, if you don't mind and you like the informations like this, then please hit the like button and consider subscribing for more daily updates and infos. Many thanks, appreciate it. So, with that out of the way, let's have a look at the blogger sentiment for SoFi. And we can see most are bullish except Seeking Alpha's contributors. Which looks like a pattern and is a bit weird if you ask me. Now let's check out Business Quant's profile. And before I forgot it, this video is not a bashing or a hype video and I will not talk gossip. No, on my channel we are analytical and free from emotions, okay? And what we can see or what jumps right into my eyes is the fact of the success rate of Business Quant. With an impressive 55% and an average return for their ratings of 11.7%, means beating the S&P 500. Hence, they know what they are talking about, folks. So now that we know a bit of their background and that they ain't stupid, let's have a look at the article itself. By the way, TipRanks was saying that they gave a sell rating and I believe with a price target of $16, but here on the website it says they gave a hold rating, just to be aware of it. So the summary says the following. Short interest in SoFi Technologies rose 12.6% in the last cycle. The company is surrounded by a few uncertainties which can weigh on its shares in the foreseeable future, and risk-averse investors may want to avoid the stock for the time being. Okay, now we know what's the article about. Let's continue and see what he says in detail. First, the shorting intensifies. Here he is basically saying that if a stock gets heavily shorted, means investors betting against the stock or that the stock will go up, and it reflects the market sentiment, in this case negative, means the stock price will fall. Further he says, short interest at the end of the latest cycle stood at 71.28 million. Which marks a 12.6% increase sequentially and a 199% increase over the last 8 months. It's worth noting that the credit services firm has about 564 million shares in the public float, which means that roughly about 12.6% of its tradable shares had been shorted at the end of the latest short cycle. This is a significant increase of shorting in the name. And so far he is completely right when he says that SoFi gets heavily shorted. But now it gets interesting. Now he compares the short interest to 45 other US stocks which belong to the credit service industry and is stating that 62% showed that the short interest decreased and only for SoFi it increased, and it continued to do so and not bottoming out. And here I have already a video. As in my opinion, first, you can't compare a Visa or other legacy bank institutions with a fintech company like SoFi or Upstart, a firm or lending club etc. And we can see on his screenshot that the short interest for lending club and Upstart are way higher than for SoFi, which proves my point here, that the whole fintech sector with their high valuations, means high PE ratios, are currently out of favor. And everyone knows that they have a hard time currently, means they are easy to short, and I explained already why in a prior video in case you want to check it out. I will link it at the end of this one. Second, and that is another important factor, these fintech stocks including SoFi have a high percentage of retail investors compared to legacy credit institutions. And we all know that retail investors like you and me are more susceptible for FUD, means fear, uncertainty and doubt, and sell faster a stock than institutions if the stock goes down or a report like this comes out. So, but let's continue the second point. Reasons for caution. Here basically he is pointing out that SoFi received the bank charter, but that the compliance costs therefore will increase, plus the debts SoFi has. And he uses the 10Q filing where it says, if we are successful in securing a national bank charter through the proposed acquisition, we expect to incur additional costs in our operations of the bank primarily associated with headcount, technology, infrastructure, governance, compliance and risk management, marketing and other general administrative expenses. Here I have a second video and cannot agree with this statement. First, Golden Pacific Bank has only 3 branches and I doubt that they will cost a lot, including staff etc. But let me know in the comments if you know how much a branch costs per year, if you know it, as this would be quite interesting. But my point here is to compare his statement and the higher compliance cost versus increased lending capabilities. Means banks operate by using deposits to offer loans. As lending is the primary source of revenue, the company will be able to expand its lending capabilities, no relying on third-party banks. By being a bank, SoFi won't have to rely on third-party banks to provide the capital, where SoFi had to pay them 2 to 3% interest prior, plus driving operations costs down. And just look at the graph. An improved marketing and pricing control while obtaining a national bank charter gives credibility to the company. Newfound pricing control will allow them to go after a larger market share while already competitive in their prices. The lower cost will let a very flexible approach from higher EBITDA that will fuel the further growth to more competitive pricing that will capture a more significant market share. You see my point here, right? So, I don't think that will outweigh the benefits of a bank charter. Third point, he compares again SoFi with legacy banks and their price to book value. Again, in my opinion, you can't compare SoFi or Lending Club with Wells Fargo or a JP Morgan. That's complete nonsense. If you want to compare, then SoFi versus Lending Club or Upstart, for example. Let's come to the takeaway of his article. Here he says that SoFi is a rapidly growing company, and with the new bank charter, the company can now expand its ecosystem of financial products, offer competitive interest rates to draw users and keep growing its revenue over the coming quarters. I totally agree with that. Further, having said that, it's also worth remembering that good business don't always translate into good stocks. The company is currently surrounded by a few uncertainties, such as rising interest rate risks, risk of shareholders dilution, risk of being re-rated like a traditional bank, which presents near-term headwinds for the stock. And here I agree with the rising interest risks, as the market shifts therefore from growth stocks to value, and therefore growth stocks like SoFi will be highly volatile in the future. And last but not least, the closing statement. Here he sees further downside potential and therefore gives a hold rating. Well folks, my opinion to all of this. I can't agree with most of the things he wrote and have a completely different point of view. But where he is right is that the stock is highly shorted because of the market sentiment. Means all the fintech sector is a target right now, but not SoFi alone. And I agree as well, as the market is highly volatile currently, and probably until the inflation is down and the increase of interest rates is finished, plus the high percentage of retail investors being invested, SoFi will be highly volatile and it will most likely continue to do so. But as I said in my other videos, the fundamentals haven't changed. Well, they have actually, but to the better with the bank charter. So for me, it is not a hold, rather I would perform DCA, dollar cost average, and will continue to buy bit by bit more, depend on the price and the market. And an important information, keep in mind that in a couple of weeks SoFi will release their Q4 earnings, and if they miss just by a bit or lower their outlook, then SoFi could drop 30 or 40% like PayPal or Affirm. Remember that, okay? But let me know in the comments what you think, as that would be interesting for me and the community. That being said, break up with bad banking and enjoy tomorrow the Super Bowl. And if you wonder how you can support me, just give the video a thumbs up so other retail investors like you and me have the chance to see this video as well, as the dang algorithm likes this stuff. Or even consider subscribing. Or maybe become a patron, and I will put the link to it in the description and in the comment box. That's it for today. Thanks for watching, and as always, stay focused and don't be greedy. See you next time.